Lads and ladies, we're going through lot sizes. Lot sizes tied directly into pips. They're probably up there two of the most important things that you need to know and understand about trading. They work hand in hand to control how much you stand to lose or gain on a trade. So without further ado, straight into it. What's a lot size? In foreign exchange trading, the term lot size refers to the number of units of currency you are buying or selling in a single trade. Lot sizes are essential in determining the value of a pip and ultimately the amount of profit or loss you can make on a trade. Understanding lot size is crucial for managing your risk effectively. Before we get into exactly what a lot size is and why it's important, I'm going to keep it simple, super simple. A lot size just determines how much a pip is worth, and we know that a pip is the smallest price movement that you're going to be able to catch. That's what you're betting on. You're betting on that pip going up or down in value, and your lot size determines the price of that pip. So just across the board, pretty much across the board, it doesn't go for everything, but across the board, you have three different types of lot sizes. You have a standard lot size, you have a mini lot size, and you have a micro lot size. Your standard, I'll show you a chart in a minute to give you a visual to understand it. Show you now. Your standard is, don't mind the units of currency for a second. Your standard is $10 per pip movement. So 10 pip movement at $10 a pip, there's 100 quid there. And then you have your mini lot is $1 per pip movement, 10 pip movement, $10. And then your micro lot is the smallest, that's your 0.01, and that is 10 cent per pip. So for the same 10 pip movement, you're talking about €1. So you can see the difference and how important it is that you understand the difference, because I tell you, there's nothing more frustrating than entering into a trade and it should have been a 0.05 and now it's a 0.5, and now you're stressing the X out of the trade because you're 10x over leveraged. You're risking 10 times more than what you wanted to risk. You stand to make a lot more, but that could also be the thing that drains your account and makes you bust out of the account. It's important that you make sure the last thing you do before you place a trade is make sure that lot size is correct, because if it's incorrect, it's going to cost you a lot of money and a lot of hassle. That's, before we break it down, that's as simple as lot sizes are. Your lot size, all you have to remember before we go into depth on it, a lot size is just a determinant factor on how much a pip movement is worth, and therefore how much it's worth in monetary terms in your account. Do you know what I mean? If you know you're at 100 pips, is your take profit, whatever, 20 pips for your stop loss, 1 to 5, well then it's right, well, how much am I willing to risk? If I only want to risk $20, well then you're going to go into a 0.10. Why? Because you're risking €1 per pip. At a 20 pip stop loss is risking $20 in order to make $100. Whereas if you wanted to risk a bit more, say you wanted to risk 200 quid and you have a 20 pip stop loss, but then you can go a one lot size. Why? Because you're still risking your 200 quid. The pip movement for your stop loss is still 20, but the amount that each pip is worth is now after going up. Why? Because your lot size is after increasing. Now, why does this happen? Is because this is where it gets a bit techie, but understand it. Just understand it in your head. Know it. Don't think about it too much. People think about it too much, and they get overstimulated. They overthink it, and then they get into a brain fart. Then they can't remember anything. And so, if we break it down, now we have, like I said, you have your standard lot, you have your mini lot, and you have your micro lot. When you're trading a standard lot, that means you're trading 100,000 units of currency. And when you're trading the mini lot, you're trading 10,000, and a micro 1,000 units of currency. If you're trading Euro USD, I think we have it down here somewhere. Yeah, for example, if you're trading Euro USD with a one standard lot, so that's a 1.00 is our standard lot, a 0.10 is our mini, and a 0.01 is our micro. If you're trading a standard lot, you're taking control of 100,000 units of currency. That's essentially what you're doing. When you put in a 1.00, you're taking control of 100,000 units of currency, and you're guesstimating whether that is going to go up or whether it's going to go down, but you're taking control of a certain amount of units of currency. Now, that doesn't essentially mean that in order for you to control 100,000 units of currency, that you must have 100,000 in your account. That's not what it means. You'll have some form of leverage. A lot of brokers you work with. We'll get into that now in a second. And then same thing then with your mini lot, you're just taking control of 10,000 units of currency, and your micro is 1,000 units of currency. Think of it like, what's a good analogy now? Think of it like buying a tray of eggs. You go into a shop, you don't say, I want 12 eggs. You say, can I have a dozen of eggs, please? Can I have 2 dozen of eggs, please? You're not going into a trade and you're not saying, right, broker, can I have control of 100,000 units of currency? It's the exact same thing. You're not asking, can I have control of 100,000 units of currency? You're going to say, I want the one lot size at this price. You know what I mean? It's the exact same thing. You're going to go into a farmer or whatever, and you're going to say, can I buy a dozen of eggs? You're not going to say, can I buy 12 eggs, please? So what the units of currency actually mean, you don't really have to stress it too much. It's important to understand and know about it, but don't think about it too much. What else have we got? Yeah, so when you have 2 seconds. Yeah, sorry, with leverage then, I want to make sure I tick everything off. I have a list, make sure I tick everything off so I don't ramble on. It's easy to ramble on. And if you're controlling 100,000 units of currency, that doesn't mean that you have to have 100,000 in your account or 10,000 in your account or whatever it may be. We trade on brokers. Our brokers are going to offer us leverage. All leverage does, if I have €1,000 on my account and I try to control a micro lot, it's going to say brilliant, no problem. If I have €1,000 in my account and I try to control a standard lot at 1.00, I'm going to get a sign and it's going to say not enough money or can't place trade or one of a few error messages. If you trade leverage, it means when you sign up to a broker, you're going to be faced with a page and it's going to say something along the lines of 1 to 50 leverage, 1 to 100 leverage. I think I might be incorrect. I think 1 to 30 is the max you can trade leverage in the US. That might be wrong though. Actually, I think it's more than that. I think it must be more than that. But essentially, it just say you have 1 to 100 leverage. If you have $1,000 in your trading account and you have 1 to 10 leverage, that means you can control 10,000 units of currency. It just means that you get, instead of getting the error message, not enough money, you're going to be able to place that trade, which is, it's good because you stand to make more money, but it's bad because you also stand to lose more money. And leverage is very important. It's a little bit later on now in the course, but leverage is really important because you have to understand that it works against you. It can work in your favor. If you have €1,000 in your trading account and you have 1 to 100 leverage, so you're able to control way more, 10, 100 times more than what's in your trading account. You can also risk 100 times more than what's in your trading account. But you risk it all. You risk everything. So you stand to gain a lot more, but you stand to lose everything as well. So it's important that you understand leverage. I don't recommend going for, people say go for the highest leverage. The reason they say go for the highest leverage is so you can control that bit more currency, so that you can risk that bit more. But risking that bit more isn't always the correct thing to do. Risk management is the most, important thing about trading. We don't need to get on the charts with this. Here we go. This will blow your mind. This is the MT5 account of a institution or a bank. We call these big fish. They're people, they move the markets. Me, £1,000 me trading accounts, not moving anything. It's not 2 pence against these guys. If I trade at 0.1 lot size, I'm risking €1 per pip. These guys are risking that $1.06 million lot. That's $10 million per pip. They're up $53 million off of a 5 pip move, nearly a 6 pip move. $53 million. There's 43,369. There's $43 billion in this trading account. Do you know what I mean? You have this sell at 80k lots. That's 800,000 per pip movement. And we know how small a pip is because we look like this XAU USD. That's 1 million per pip. Sorry, that's 10 million per pip on a 5 pip move. We looked at it. If you go on to this and go on to this, no, go on to actually this one. So bear in mind that was a 5 pip move. Now if we go on to this and then bang, and then go bang, that's a 5 pip move. This big move on gold, 10,000 pips. Mental, absolutely mental. Say from here up to here. What are you talking about? 4,800 pips. 4,008. Imagine 4,800 pips at 10 million a pip. That's not even maths throwing out the Troy deal or Troy attempt, but it's a lot of money. So it's important to understand as well that these the institutions that you're playing against, man, align yourself with them. Find out what they're doing. They all run off of algorithms. You think of people trading, it's not the way it used to be back in the day where you have a load of rich guys in suits screaming at their monitors, picking up the phones, and it's not like that anymore. Now a lot of it is algorithmic trading. You get me? It's just a little computer. When you have a screen, it's just a computer that's told to do this thing, told to do one thing, and it continues to do that thing. So if it's an algorithm that the banks are playing off, well, then it's just as simple as understanding the algorithm and going alongside them. Because there's no point in betting against somebody who has 49 billion quid in their bank and you have 10 grand, whatever way it may be in your account. It's never going to work. You're never going to win. What have we got next in terms of video content? Candlesticks now starts to get a bit more interesting, and then trading view explained, and then risk management, and then we're in time zones, and then we're getting more techie. Then we're getting into the charts. Although people don't like YouTube videos, and where they see all they see is this. This is the art of trading. Do you know what I mean? You have to understand all this before you can jump onto a chart and understand what any of this means. Do you know what I mean? It's hard to understand what this means if you don't know what everything else means that we're just have been running over. So with that, we'll get straight into the next video. So we will, which is candlesticks. So jump right over there, 10-minute long video. Take your time, take your notes. Make sure you're taking notes along the way. With the lot sizes, don't think too much about the units that you're trading. Just kind of know in your head that that's what you're doing, but don't think about it too much. Like I said, just think about this. What have we got here? Oh, I can't find it. Just think about the volume and the price per pip, just your lot size, and then how much your lot size is worth. Do you know what I mean? How much a pip is worth determined on your lot size. Don't think about the units too much because you'll get into your own head about it. You'll try to understand it, and if you don't understand it, well, then you're just not going to be able to understand the whole of lot sizes. When it's really, you really don't have to understand it, just have to be aware that that's what's happening. So look, we'll shoot over into candlesticks now, and we'll get into the anatomy of a candlestick.